The broadcast is now starting. All attendees are in listen-only mode.
Good evening and welcome to our brand new of 2022 Digging into the BI magazine. I want to welcome you and I hope everyone enjoyed their New Year's celebrations and are ready to settle down to hear some better investing ideas. First, I want to draw your attention to the handouts. You are able to you should be able to download them into your own computers. Please go ahead and do that. Also, there is a question box where you can list questions and put them in there. And we have people watching the question boxes. I hope everybody can hear us all right. Tonight, we are going to have some new presenters. Ty Hughes and Fred Beckman are new to our presentation list. And we're going to be looking at the following stocks: Borg Warner, McDonald's, Medpace, and LCI Industries, all worthy candidates from Better Investing. And we have our usual disclaimer. This information is for educational purposes only. None of us are professional analysts or sellers of stock or equities, and so we make always this is a recommendation. This is intended to not be a recommendation to purchase or sell any stocks, mutual funds, or other securities that may be referenced. We urge you to please do your own research and when you're looking into these stocks. And the presenters are not endorsing or promoting the use of these websites, products, or services. And the session is being recorded for future use and will be presented also on YouTube, our YouTube channel. Who we are. We are Better Investors. We're an investment education organization. That is our main mission, is to educate people to be able to do their own investing. And we're focused on long-term fundamental investing. Means we're looking at things like the revenues or sales and earnings per share. These are the type of things that we're focusing in on. And we're all volunteers in the Mid-Atlantic region. This is how you navigate within this web page. You have a control panel with the default in the upper right. You can collapse or expand by clicking the orange and white arrow box. You can move things by grabbing with your mouse, and by default, all microphones are muted, but we will unmute during question time. Or you also can raise your hand during question time, and we can unmute you, or you can unmute yourself if you're self-muted and ask your question. And then there's always, as I said, that question box. You can type in there and you can send it privately or to everyone. Additional help using the GoToWebinar. There's a 4-minute video on getting started. If you have any audio problems, however, check your computer audio settings first. Sometimes people will mute their computers for something they did previous to this webinar, and then you have to go into your own sound settings and unmute yourself. You can also look at the help key, and you can look at your own audio settings. Don't forget, as I said, to please download those handouts. For your improved viewing or capture image, you can click on the zoom. You can see in here that what the zoom is. It's 87% right here in this example, and there's a little screenshot button, and you can then set your own settings to make it bigger if you want to, or smaller within your own computer. And why this webinar? Main mission is we've noticed that sometimes people do not understand how to use or how to look things up in the BI magazine, and the BI resources to find stock ideas. Now, for people who do not belong to BI but are tuning in right now, we can get you a 90-day free trial so you can look under the hood and see what's going on with the Better Investing website. We focus on those who are beginners or uncertain of how to do judgments on the stock selection guide. Obviously, people who belong to Better Investing know what I'm talking about right now. And for people that are just getting started, sometimes they're uncertain of how to get through the stock selection guide, which is our major tool to get to find out whether stocks are of value, of quality, and also if they're on sale. We want to help the investor who wants to look at best practices, help them to find what is the best stock maybe within a certain industry or a certain portion of the stocks. And so this helps you to make sure that you buy the best. This is also brought to you by two joint programs of two Mid-Atlantic chapters. That is the Northern Virginia chapter, and also which covers Northern Virginia, DC, and parts of Maryland, and the Maryland chapter, which covers the remainder of Maryland. And we want to promote, there's 3 model clubs in those 2 groups, one being the Model Club McNova, which is from Northern Virginia, and then MCMC, which is Montgomery County Investment Club, and the Maryland Chapter Model Club. And we invite you to be a part of the BI community in the Mid-Atlantic and to join with us. So in just over an hour, we're going to present 4 stocks that come from the BI community. 2 presentations from the BI magazine. This is for members only, the magazines come out. One is the monthly stock to study. The other one is the monthly undervalued feature. And 2 presentations from the BI website or BI magazine or personal experiences. Some places that we have within Better Investing website that people might get their ideas from are First Cut, online screening tools, Ticker Heat Map, Ticker Talk, the BI Weekly Screen, Growth Stock Column, or the International Stock Column. And right now, Better Investing does not have the magazine out for the 2 months, January and February. They usually combine those 2 months for the magazine at this time of the year. And unfortunately, they haven't put them out in the screen. But you can look at these and see for the future how you're going to be able to find the magazine in advance to locate what the stock to study and the undervalued feature are within those magazine issues. You'd go to the Welcome to the Better Investing tab. You click on About Us down in the green area, and then you can click, or you can click all the way down at the bottom. There's also says About Us that's circled in red, and that's at the very bottom of the web page. Also, you can click Home and find out the Better Investing magazine update. And here it is showing for McDonald's and Borg Warner. And you can click on the little blue button that says Read More. And so you don't miss future announcements, you can click on your account up in the very top right-hand corner next to your name. After you've signed in, you should be able to see the My Account pop up. And then you would go, after you clicked on My Account, you'd go down to where it says Email and Product Subscription Information. And then it will take you to this page where it says, down at the bottom, it says Save Changes after you have clicked on the different boxes. So the different email subscription and information you have 4 different boxes there. And you can click on the top one will get you the Better Investing Weekly e-newsletter. The second will get you the member announcements and promotions. The third one will get you partner events and offerings. And then the fourth one will enable us, the local chapters, both the Maryland and Virginia, or DC regional, I should say, get you our news and events. And then you would click on the green box at the bottom that says Save Changes. So also in one of those selections was the Better Investing Weekly newsletter. And this is a member exclusive, highlights the national education webinar announcements, which can be ticker talk, first cut, or stock ideas. It comes out close of business on Thursday. And if you signed up and don't get this email, check your spam filters. And you can also connect with us on Facebook. There's the link, and these are hyperlinks for the DC Regional, and the second one is the hyperlink for Facebook for the Maryland chapter. And we have the DC Regional Chapter Book Club. This is on the third Tuesday of every month, from 7:30 to 9. January 18th will be that new day for the book club, that third Tuesday. And we are going to be offering Common Sense, The Investor's Guide to Equality, Opportunity, and Growth by Joel Greenblatt. And it's free and open to the public. The hyperlink is down below there. Whoa, sorry about that. And you just click on Please Join Us Online, and that will take you there. There's no registration required, so please come join us. So we have the Maryland chapter. There you go.
Hi. I'm Kent Young, and I'm representing the Maryland chapter from here in Sioux Falls, South Dakota. The chapter is sponsoring a stock picking contest, which starts next Sunday. The deadline for entry is this coming Saturday, so I strongly suggest you check out the rules for the contest. And if you go to the Maryland chapter website and then click down on news and articles, you can find out information about the stock pickers contest, and the rules for the contest are right there. Next slide, please. And now I'm switching hats to represent the Maryland Model Investment Club. The MMIC gathers the second Saturday of each month from 10:30 to 11:45-ish. The MMIC provides an example of how an investment club might run, and it demonstrates club operations as well as investment and portfolio management decision-making. Each month, the club has an education segment, a new stock study, as well as a review of current holdings for the club. And we're currently meeting each month during using GoToMeeting, very much like we are there, and the link is right there. So look forward to hearing or seeing each of you. And that's all I have.
Okay, Ken, if you would introduce yourself and tell us something about MCMC.
Okay, my name is Kenneth Williams. I am with the Montgomery County Model Investment Club. We started in 2017, and we currently have 8 partners. We meet the third Wednesday of each month from 7 to 9 p.m., typically at the Rockville Library, but since it's closed, we've been meeting online. There is our GoToMeeting link if you'd like to join us. Our education segment for this coming meeting will be looking at cash flows, and we'll have a stock study for Medpace. If you if you have questions about our model investment club, you can reach out to Marilee Hardesty at mshardesty@aol.com.
Okay, thank you, Ken. All right, I didn't introduce myself, and I apologize for that. My name is Cheryl Patterson, and I am a member of the Model Investment Club of Northern Virginia, otherwise known as McNova. We have our next meeting on a new day. We're meeting on the second Tuesday of each month, which is upcoming as January 11th, tomorrow, and it's from 7 to 9 p.m. We were meeting also at the Tyson's Pimmett Library in Falls Church. However, due to conditions beyond everyone's control, we are still meeting online. And there is the hyperlink that you can go to right from this slide. And you can also dial in using your phone, and there's the numbers and the access codes. This month, our education is going to be investing financial ratios. And the stock study is LCI Industries, which you're going to see our presenter tonight for LCII. And you can reach out to me, Cheryl Patterson. There is my email. It's srap14@gmail.com. If you have any questions about what's going on with the DC Regional Model Investment Club. Also, if you are a club member, what you can do if you are looking for new members is you can fill out a form to promote Visit a Club for your club. And it's a pretty simple form. There's an example up above. Or if you are an individual person looking for a club, there's also, you can reach out to see what clubs are on that list. There it is, both for the Maryland chapter and the DC regional chapter, as I said before. Also, if your club is looking to have a presenter come from the chapter, we can grant your wish for that, and you can contact me. We'll show the emails again at the last slide, and we'll see about doing a visit with your club. And again, with the magazine being for 2 months, this month and next month, it has been somewhat delayed getting out there. But we're all still waiting for the post office to send ours. But keep looking on the BI website, and maybe hopefully pretty soon you'll be able to go to the directions that I gave out earlier, and you can find the magazine online. Also, there is a learning center for the BI magazine, and you can get to it there. That's one of your options. In the blue box over on the left-hand side, you can go to either the Better Investing magazine for mobile devices or the analyst reports and other resources. And then you can see view the magazine issues and the details and such. And they also have archives for the previous editions as well. And Kevin, who is usually our announcer, has other commitments tonight. And so what he does is he likes to look at something, an article that was in the magazine, and he's looking at the December issue, since that is out on the website, and looking at model portfolios looks to FedEx to deliver. And you can read that magazine article. As I said, it would be in the archives for the BI magazine from the places that we showed you in the previous slides. And you can read about FedEx, because we see the trucks out there lots of times. So it's interesting to see how they're doing on their stock as well. Okay, tonight we will be dividing up in half. Half of the speakers are going to be looking at their stocks using the core SSG. And that's kind of the SSG on training wheels. It breaks things down a little bit further for people who are beginners. And the other half will be looking at the SSG Plus, which is for people with a little bit more experience using the stock selection guide. So first we're going to start out with Ken Williams looking at Borg Warner. The ticker for that is BWA. And take it away, Ken.
Okay, next slide. All right, so I am doing the undervalued feature for January, which is Borg Warner. Next slide. The automotive industry has 3 tiers of suppliers. The tier 1 suppliers supplies major components such as specialized engineering core components such as engines, drivetrains, and the chassis. Anything highly technical that helps the vehicle to operate. Tier 2 is less specialized. Components such as car windows, window motors, door handle mechanisms are developed here. And then tier 3 is more basic components, which include window glass, upholstery, and other interior materials. Next slide. Next slide. So why is this significant? Being a tier 1 supplier gives Borg Warner an economic moat. Borg Warner makes automotive parts for well-established car companies. These companies are unlikely to switch to component suppliers at a moment's notice. Borg Warner knows and understands the specs for their car products and can adapt to changes in the market. Just kind of tab. The company also has a moat around scale advantage. The company's business is diverse among car companies and geographies. Many countries have laws that require car components to be sourced in the same country. Borg Warner has a physical presence in 18 countries, which makes these laws much easier for them to satisfy relative to smaller firms. Also, low transportation and shipping costs are a benefit of the company. You can hit the space bar. Okay, so we're off to the next slide. Transforming vehicles to more fuel-efficient, cleaner technologies requires a collaborative partner who understands evolution of mechanical and electric systems. The company's expertise in both provides a critical underpinning to efficient and powerful propulsion. Integrating electronics into the mechanical system is the key to performance, packaging, and cost. This is evidenced across a full line of combustion, hybrid, and EV products for light vehicles, medium and heavy duty vehicles, as well as off-highway applications. Next slide. At present, the company generates only a small portion of its revenue from electric vehicles. The number provided for 2021 is about 350 million, or about 3% of sales. The goal is to expand this figure to 10 billion by 2030, which would translate to 45% of the company's overall sales of 22 billion. That implies an annual growth rate from 2020 of 8.1%. If this comes to fruition, the bottom line of the firm would be material and indicate significant upside potential, irrespective of the multiple that shares for trading. Next slide. Borg Warner has made several acquisitions to build its electrification product portfolio. The culmination of these acquisitions is expected to result in 2.5 billion in revenue by 2025. So you can see the number of acquisitions they've made since 2015. The one that seems to be most significant is the 2020 acquisition of Delphi Motors. That was a major acquisition for this company. Also, Akasol is their most recent, and they're helping to build and give them battery pack products and modules. Next slide. Electric vehicles can potentially make a vision of a future with emission-free mobility of reality. Borg Warner's product portfolio already covers virtually all fields of technology that are critical to electric vehicles, including electric motors to power transmission and to power electronics to thermal management. Next slide. COVID-19 was slowing down production on orders in 2020. Analysts see this as a temporary headwind. High operational leverage can slow growth during periods of downward trending revenues. The company is consistently having to invest in innovation to stay ahead. High R&D costs can hurt margins during market downswings. Next slide. This chart comes from a Seeking Alpha article. Taking these figures, we can effectively see that effectively price the business. At present, the company is trading at a price earnings multiple of 11.3. Its price to operating cash flows flow multiple of 7.7, while its EV to EBITDA multiple of 7.4. To put this in perspective, compare the company to the five highest rated of its peers, as defined by Seeking Alpha's quant platform. On a price to earnings basis, these companies range from 9.7 to a high of 47.7. Of these prospects, Borg Warner is the cheapest. Looking at an operating cash flow approach, ending up, you have a range of 10 to 125.9. Once again, Borg Warner is the cheapest of the group. Not surprisingly, all five firms appear to be more expensive than Borg Warner. Next slide. So looking at the value line, it suggests that little or no P expansion over the next 3 to 5 years. The 3 to 5 year annual return projections are in the range of 9 to 20%. Estimates for 3 to 5 year revenue and earnings growth are 8.5% and 8% respectively. Next slide.
5 minutes.
DFRA rates Borg Warner as a buy with a 12-month price target of $60 and a fair value calculation of $63.94, which suggests that the company is trading at a 46% discount to fair value. Equity analyst Garrett Nelson Brooks looks favorably on the company's recent acquisition of Delphi. Next slide. Simple Safe Dividends has been a useful resource to me in evaluating dividend-paying stocks. Borg Warner offers a 1.5% dividend with a safety rating of 50, which suggests moderate risk of a dividend cut over the full economic cycle. The company has consistently paid a dividend over the past 7 years, and the dividend growth over the past 3 years has been rather flat. Next slide. So going to our SSG, I selected 8.5% as my 5-year sales judgment, which is based on the Value Line 5-year estimate. Using Value Line inputs for shares outstanding, income tax rate, and profit margin, I ultimately use a preferred procedure to obtain the 5-year earnings judgment of 9.3%. Next slide. My judgment for the 5-year high and low PE is the 5-year average high and low PE of 17.9 and 10.3 respectively. I use the resulting low price of $33 as my 5-year low price. Next slide. Borg Warner closed at $45.10 on December 31st and was in a buy range at that time. Next slide. This results in an annual rate of return of 15.9%, which is within the projected annual total return range of 9 to 20% suggested by Value Line. Next slide. Borg Warner projects that its strategic growth actions will result in 25% and 45% revenue growth in 2025 and 2030, respectively. They expect to sustain market performance while funding EV and RD investments. And their portfolio management is expected to contribute to their positioning in the EV market. Next slide. So in conclusion, Borg Warner is a large company with moat characteristics. It's well managed. It's trading at its 5-year average PE. It's a worthy candidate for you to add to your watch list. And it is a buy up to $47.10. Next slide. And we're off to Ed.
Good evening, everyone. I'm Ed Rodriguez, and I'll be presenting McDonald's. Next. So the principal reason why we're doing McDonald's is, as was mentioned before, it's the stock to study in the January 22 issue that still hasn't come out. However, if you look on the website or the magazine, you'd also find it among the most active list. So that is often another good place for you to get some ideas for you to do analysis against a prospective stock. Next. So I don't think I need to explain to anyone what McDonald's is. I think everyone knows McDonald's. And in fact, in the words of a Morningstar analyst, it is the unquestioned leader in global food service sales. Next slide, please. So I'm not going to go into a lot of history here, but I did want to point out two key things that are on this slide. One is that, you know, from its modest beginnings back in 1948 through currently, McDonald's has grown to 36,000 restaurants in 100 countries in the world. Truly a pretty impressive achievement. The other thing I want to draw your attention to is the growth of McDonald's stock from 1970 through 2021. There are two things to note here: is that it has been very consistent in its growth, and B, that it has grown pretty considerably. Next slide. So how have they done this? Next. So, you know, in many corporations, this saying is very applicable, and certainly to McDonald's that has been around for so long. And it is something from Bob Iger, the former CEO of Disney, and it's a phrase in short: innovate or die. If you're not continuously reinventing your business, you're going to grow stagnant. It will die. And as we show on these presentations, there is the life cycle of companies, and you know, companies actually do go bankrupt after a certain point in time if they don't thrive. So the four elements on the side here that I want to highlight that I think are very important from a McDonald's perspective has been clearly they sell food. So the menu over time, how do they deliver their food to you? The experience that customers have in their store, and lastly, the branding associated with this. Towards the top, you'll see a variety of food. Some of it you've probably ordered yourself over time. Towards the right, you'll actually see some stuff that you might not even have seen in your life, including onion nuggets. These represent, you know, failed efforts from McDonald's in terms of sandwiches that they tried and didn't work out so well. Again, success doesn't come without failure, so it doesn't mean that everything they do is great, but they do try to innovate, and every once in a while, they'll be successful. Even the way they deliver food to you. On the far left, the countertop experience where you order and you get your food, as it's migrated all the way to the far right there, where McDonald's is actually looking at integrating services like DoorDash and Uber Eats directly into their app. Again, an emphasis on customer experience, a seamless experience for them. And at the bottom, you know, they've certainly protected their brand. It is a worldwide brand. And even things that are as iconic as Ronald McDonald, at some point that turned out to be problematic for them, so that got dropped. So again, you innovate, you adapt, or you die. Next slide, please. So one of the things that over the last 2 years, I think has been a concern of mine, and certainly most of you, if not all of you, is really companies that have been hit, and we all know about how badly the restaurant industry has been hit. So I wanted to take a step back and take a look at two management consulting firms and see what they had to say in regards to what are some of the key elements that people need to do to not just survive, but thrive in this post-COVID time frame. So as I've looked at each of these items, next slide, please. I've actually found in my research that most of these elements are things that McDonald's is addressing, and I've gotten confirmation of these things by looking at reports. I've gone online with investor meetings and things of that sort. Looked at their reports, so I'm very much impressed and confident in regards to that they're doing the right thing. Next slide. So this is a quick overview. I won't go through this in detail, but this is what McDonald's presents to investors and stakeholders as far as their strategic vision. Key thing to point out, second from the bottom row, is actually a pretty cute thing they do with their ticker, which is MCD, which has been expanded to kind of reflect what their growth pillars are, to include, if you note, the third one, D, heavy emphasis on delivery and digital. Again, those were some of the major themes from the slide I just discussed a few seconds ago. Next slide. So let's dig in a little bit deeper into McDonald's here. So one chart, and I've used this before, and this is from the Morningstar website. And what they do is they plot what they calculate to be the fair value of a stock versus its actual stock price. And in this chart, I looked at it and I noticed a certain characteristic for this stock, and that is over the time shown here, for the most part, the stock price has been below the fair value price. It typically will catch up, and you see that the fair market price has risen from about 100 to, I don't know, 240 in this chart. The thing that caught my attention that I wanted to draw out was, in the last year, in 2021, it appears that the stock price has accelerated above the fair value price. And this is something that's kind of uncharacteristic for this. So I take note of this to kind of start wondering, is this stock overpriced? And, and I continue with my analysis. Next slide, please. So
5 minutes, Ed.
Thank you. The next thing I look at is the analyst perspective. Here you have a neutral with 3 buys. Some of the highlights, and I think you heard in the previous presentation reference to a moat. Again, moat is a persistent competitive advantage that a company has. And what that allows you to do is to, frankly, charge more than your competitors and therefore have higher profit margins than your competitor. So generally, McDonald's is considered to have a wide moat. Those are some examples of where it comes from. In recent times, their revenue, income, those are all increasing. What I take particular note in is the operating margin going up. That's a pretty powerful number. And you'll notice there that the third and fourth dot points, these are some initiatives of where McDonald's is striving to improve efficiencies. The last item is actually looking at standardizing across those thousands and thousands of stores to get economies, as well as have access to data that will allow them to make better choices on menus. Next slide. So here's the SSC, just as the front side of it. I want to point out a few things on this slide. Now, number one, very disconcerting to me is that even before the pandemic, revenues were dropping. So to me, that is a really important thing. And I look for how people are going to explain how they're going to have a dramatic uptrend, especially in a post-COVID environment. Number two is the numbers that I've used for growth and EPS projections are essentially at a value line. Number three, over to the right, you can see that over the last year, quarter, you see some pretty substantial improvements. Again, this is them coming out of a COVID recovery. So the numbers are a little bit skewed in my estimation, and my second number 3 there at the bottom are some numbers that really are rather good or comparable to the peers that I used in the analysis for McDonald's. Next slide. The backside on this, I don't know if you'll see it, but basically the estimated high PE, average PE, was 28.4. Last year, it was in the 30s. So again, it's a little disconcerting to see what I would consider to this analysis having a contraction of the PE. And so that, to me, was at that point, frankly, I kind of figured that the final outcome of this wasn't going to be positive in terms of buying the stock. So I cite that as maybe something when you're doing these analyses yourself to kind of think about how these numbers compare to historical numbers. Number 2 is the low price. I actually used 2 different methods to calculate that number, and they both came out kind of comparable. So that was good confirmation. And as I sort of expected, and you see here, the conclusion was that this is a hold. And now let's look at that graphically. Next slide. So as you can see here, with both ways to zone this, the 25, 50, 25, and the 33, 33, 33, in both instances, the price winds up right in the middle of hold. It is important to note that when this stock was selected for the stock to study, it was probably back in November. Maybe I took a guess at maybe November 30th. At that time, the price was $250, which was basically a smidge below the buy point in the 333 zoning there on the right. So it doesn't, it's not an outrageous situation. It's just that the price has appreciated, and its current upside downside is 1.3 to 1. Next slide. So historically, it's a large company. It doesn't grow fast. In fact, frankly, if you take a look at the numbers, it has a history here over the last 5-6 years of not growing. It's a well-managed company. I think when you look at all the things that they've been doing, some of the margins increasing, the digital pivoting that they're doing to make things more efficient, I would put that in the category of they're doing a lot of right things. It's fully priced according to the SSG. It's a hold. And in contrast to in the past where I might say, hey, you know, it's a hold, but, you know, I'm kind of optimistic on this. I don't feel that way with McDonald's. I think they have to have a lot of things go right. They have to turn around their sales decreasing to pretty substantial growth increases, you know, revenue increases. I don't see the story for that. They're improving margins. And also, let's remember that this company is in an area that's frankly today unattractive and still risky, and that's the consumer cyclicals and it being in the restaurant industry category. So I believe that's it. Next slide.
Okay, this is the halfway point, and again, we're looking at the Stock Selection Guides Plus, which is for users that have a little bit more experience. And we're going to have 2 presentations, and beginning with Fred Beckman. So Fred, take it away.
Hi, I'm Fred Beckman. I'm an individual member, and my company is Medpace Holdings. I found this company using the Better Investing online screening tool. Next. This is really easy. You just go to this and click on the magnifying glass. Next. Then up pops this screen where you can choose various factors. This is actually the first time I used this, and I found it very helpful. I clicked on small size company. I scrolled down to healthcare sector. I chose pre-tax profit with an upward trend and return on equity with a trend going up. And at that point, I had 175 companies left. So I screened it some more by using the Morningstar Growth, Profit, and Financial Health with a grade of B or better. And that gave me just 2 companies that met all those criteria. Next. So Medpace performs, it provides tools and it performs services to the pharmaceutical, the biotechnology, and the medical instrument firms. And what it does is it acts as a clinical contract research organization. It provides clinical trial monitoring, analysis, and data management. So what does this mean? It's basically if you have a company a biotech or pharmaceutical company that has a new drug that they want to bring to the market, first it has to go through clinical trials. And Medpace will develop that trial, get the participants, the patients for that trial, and then monitor the effect of that drug on the patients, collect all the data, and after you go through phase 1 and then a more complicated phase 2, phase 3, phase 4, they then analyze all this data so that it can be presented to the FDA for approval. And if it goes to a foreign country, then Medpace knows the regulatory approval process in that European or Asian country as well. Medpace has about $1 billion in annual sales, 4,000 employees in 40 countries. Next. So there are a lot of strong ratings by the analyst community. The picture here is a quantitative stock report from CFRA, which rates it in the 4th percentile as strong buy. Schwab rates it in the 1st percentile, strong buy. And Motley Fool has said this is an all-in must buy. Next. Looking at the stock selection guide, we have 5 years of data since it became a publicly traded company in August of 2016. And these lines are all very healthy looking, up straight and parallel. Next. I think this portrays with the green graphs very positive trends indicating excellent management decisions. If you look at that percent pre-tax profit on sales, you can see it goes up, 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 5, 13, 14. In 2020 it was 18.2%. And percent return on equity likewise goes up every year and was 17.2% in 2020. And the percent debt to capital remains a very manageable 12.5%. The CEO, by the way, before he founded this company, was a reviewer for the FDA. So he certainly knows what it takes to get a drug approved. Next. So sales growth rate forecast was not very difficult. If we look at 2015 to 2020, it was about 23.4%. The analyst consensus for the next 2 years is 21.4%. We haven't got the final results for 2021, but it looks like it's going to be around 23%, maybe up to 26% if there's an earnings sales rather surprise. So my 5-year sales growth rate is 20.9%. You can see that this first line of all the historical data in the SSG came out to 20.7%. Next slide. The value line valuation criteria, I just want to point out maybe 4 of them. At the top, we have net operating revenues per share. And again, every year, those values went up. Earnings per share, every year, those earnings increased at a nice, healthy pace. At the bottom, the net operating revenues, once again, we see growth from 371 million, 436, 705, 861, 926. And by the end of 2021, we're estimating that this total revenues will be 1,145 million. And the operating margin is a healthy above 20%. Next. The percent pre-tax profit is better than all of its peers. Now for the peer groups, I had to make some adjustments so that we're comparing apples to apples, or in this case, contract research organizations to contract research organizations. So I chose Icon, IQVIA, and Syneos Health as the peer group. I want to point out the black line that depicts Medpace. Starting in 2015, it goes up and up and up and up and up. And for the 3 quarters of this year, it is even with the performance of 2020, which is 18.2%. And this is better than all the peers for 2020. Next slide.
5 minutes, Fred, 5 minutes.
Earnings growth rate forecast. This is much more difficult. The data in the SSG shows an annual rate of 90.5%. Now, does anybody believe that this company is going to continue growing at 90% every year in the future, in the next 5 years? Oh, no. So the last 3 years, the growth rate was 56%. Can I apply that into the future? Well, probably not either. So the estimate for 2021 is around 23.4% growth to $4.74 per share. And the analysts that I was able to find for 2022 had a range from 14 to 19% for the growth projection for next year. So my 5-year earnings growth forecast is 19.9%, which I think is reasonable. Next slide. Percent debt to capital is the lowest of the peers. You see the black line at the bottom. It's much lower than the competitors. And then once again, I focus on 2020, where it's just 12.5% debt to capital. Next slide. So to determine the forecasted high price, first of all, I looked at columns D and E for the high and low PEs, and I threw out the 2016 because they were just totally inconsistent with the other years, and that was the year of their IPO, so that's to be expected. So the average high PE was 36.3, and that gave us a forecasted high price of $435.40. I chose for the forecasted low price $154. So how did I come up with that? Well, I just used 80% of a recent price of 192. But prices have been going down, so today's price is 187.08. Next slide. The calculations come up to an upside downside ratio of 3.7 to 1, a total return, the high PE, of 15.2%, which means that this stock could double in 5 years. And to achieve the 3 to 1 upside to downside ratio performance, one would have to buy this stock at less than $216.50. Although you could buy it up to $224.30 and still be in this green zone of growth. Next slide, please.
2 minutes, Fred, 2 minutes.
In addition to the excellent performance, there's been a lot of merger and acquisition activity for companies that are just like Medpace. LabCorp acquired Toxicon, Thermo Fisher bought PPD for like 17.5 billion, and a private equity company bought Par Excel. This all happened last year, so there's that potential for Medpace as well. The demand is steadily increasing for outsourcing clinical services, and there's immense pressure to get new drugs and devices to the market. Next slide. So I used to be an aerospace risk manager, so I'd like to talk a little bit about risk. Unlike biotech companies, these contract research organizations are less volatile. They provide diagnostics and research. Number two, Medpace provides services to a very broad range of medical industries. Thirdly, it is not dependent on a single customer. Matter of fact, the largest 10 customers only account for 24% of total revenue. Fourth, the biotech market itself is just growing leaps and bounds. And so the Medpace accessible portion of that market is also growing by leaps and bounds. Matter of fact, backlog book-to-bill ratio is 1.38. So there's lots of work for them to do. Next slide. In conclusion, Medpace is a small, explosive growth, well-managed company. It's trading slightly above the 5-year average high PE. I believe since the IPO was only 5 years ago, that this is probably normal. Medpace is a buy up to $224.30, and you can achieve a 3-to-1 upside downside ratio at $216.50. I believe it's worthy of purchase consideration. Thank you.
Thank you, Fred. And hi, I'm going to make you the presenter now. Hold on one second. And all right, you should have the pop-up to, yep, I see your slide. Just enlarge your screen and we'll be good.
Okay, good evening. I'm Ty Hughes. I'm in the DC chapter. I've been a member since the 80s. I'm in the McNova Model Investment Club as well. So my stock tonight I want to talk about is LCI Industries. It's a consumer cyclical stock, and the subcategory industry, it's mostly recreational vehicles. Sometimes because of its diverse product lines, it gets lumped into auto parts, but it's primarily recreational vehicles. This is a brief description of what they do. They basically build out trailers and RVs for the manufacturers. So they'll put the chassis together, put a lot of the interior inside of it. They also provide a wide range of supplies, appliances for manufactured homes, buses, boats, trains, trailers. They have a big expertise on steel chassis, and then they can make all kinds of customized vinyl and aluminum accoutrements for these vehicles. They have 36 factories in the U.S. and Canada and 5,800 employees. Their revenues this year are going to approach $4 billion. They had been about 2.7, but this 2021 was a very strong year for them. So how did we find this particular company? It showed up in the Value Line Better Investing screen on the BI website. It's been a recommended stock in Doug Gerlach's Small Cap Informer. I have a strong preference for mid-cap stocks. This is a mid-cap value stock. It also pays a decent dividend, which I think will give it some downside protection as the economy changes and the market changes this year. The projections by the RV Industry Association, this has been a very strong year for RVs. As you know, their sales have been through the roof. Even used RVs are selling at very high valuations. And the RV Industry Association predicts that the interest in RVing is going to increase into next year. They project about a 4% increase in sales. That's not huge, but they do project a greater interest among Americans in going out and camping and spending time in RVs, family time. And of course, COVID has increased the interest in that. So this is just a couple of slides from their investor presentation. This is just sort of an overview of the kinds of things they can do. You can see they've got 7 different core competencies, and this enables them to do a lot of custom work for the original manufacturers. And on the right-hand side, you can see all the different areas that their products touch. It's not just RVs, although you'll see later that is about half their revenue comes from RVs, but they also a lot of the custom appliances and accoutrements that are useful in RVs are also used in marine vehicles. So this is their core business is North American OEM. That's where they're building out these trailers and providing specialized appliances for trailers and boats. These are they've had pretty strong, not super strong, but you can see here compound annual growth rate of about 6%. The adjacent industries, these are where they're taking their technology and they're using it in other areas, marine being one, and then some of the commercial vehicles. That area has shown a lot more growth. They have a 20% growth in there. The aftermarket, even if RV sales don't continue to grow strongly, they have a very strong footprint in the aftermarket. They make all of the kinds of things which make RV vehicles fun: stoves, refrigerators, air conditioning units, camera systems, and audio visual systems. So they have a big footprint in the aftermarket where they sell accessories for RVs and for marine vehicles. They're growing internationally. They've just acquired a company, Furrion, in Hong Kong that has offices in the UK and a big factory in Indianapolis. So they're hoping Furrion's product line is primarily stoves and refrigerators and other appliances for recreational vehicles. So they're enhancing both their aftermarket and their OEM capability by that acquisition. This is a little bit about Furrion. So here's how I just did a calculation from the 10Q. This is how the business segments line up. And you can see that trailers, fifth wheels are the RV part of it is about 50%. The adjacent industries is 25%. Aftermarket is 20%. So those are all sizable segments. U.S. versus international, 91% of their business is in the U.S. They're hoping to expand with the acquisition of Furrion some of their international sales. So here's some charts. These also came from their most recent investor presentation. The one thing that's not on here, their earnings per share were actually a little bit off this last quarter. But the important thing is the sales trend continues to go up, and diluted earnings per share has been growing as well. They did, and significantly, the free cash flow this last quarter was way down. That's a little bit of a, I won't say warning sign, but something to watch if you were thinking about investing in that. I'll explain later. There's a number of reasons why it dropped off this last quarter, but that's not characteristic of how they've been doing business. This was it's helpful sometimes if you see an odd number to go to the management discussion and analysis section of the 10Q or 10K, and it'll explain things that may not be apparent. They didn't talk about this on the earnings call, but what happened in this last quarter, they bought Furrion. That was a $147 million purchase. They got hit with inflation, steel and aluminum in particular. If you follow commodity prices, those have gone up fairly dramatically, and they also got hit with they're having a real labor problem finding qualified craftspeople to work on their equipment. So they had a lot of expenses this quarter, which drove their cash flow down. So here, let's look at the stock selection guide. I always go to Value Line for some key data, and I just pull this out here. If you haven't done this, there's some things that you need to feed into the stock selection guide. So one of it is pre-tax profit margin. Basically, you take the profit margin and divide it by 1 minus the tax rate. That's the little calculation there. So the pre-tax profit is always higher than the net profit margin. Also want to look at the projections for growth. Value Line used 13.5% revenue. I only used 9 in my projections. I was more conservative. And then the other part, when you do an SSG, you need to make sure that you're accounting for stock dilution. So show you where these are where the numbers plug in on the SSG plus. So those numbers that I just showed you, the revenue growth of 9%, pre-tax margin of 9%, tax rate of 21, and shares outstanding. They're doing a little bit of buyback, and that's how you get the preferred EPS growth using the the stock selection guide.
5 minutes, Ty. 5 minutes.
Thank you. This is what it looks like. You know, kind of upright and parallel. It's looking pretty good. You can see the earnings. The price has gone up a little bit. It's not as much of a bargain. It's still in the 3-to-1 ratio, but this is a good graphical depiction. Another thing that this does pay a 2.4% dividend, and then the lower right there that I have the red block, you always want to look at what percentage payout is going on to get to the dividend. If the dividend's over a 50% payout ratio, there's always a question whether the company can continue to maintain that high payout ratio. But here, it's about 40 in the 45% range. This is some of the other graphics from the stock selection guide on the Better Investing. I used the one on the website, and you can see it's just in the buy range, a little bit below. This is when I did this over the weekend. It was 152. The stock today is 151.80 cents. And then with that, I always use average par when I compare stocks, and we're still getting a pretty nice 18% return. If you dial back it's really very dependent on the growth, obviously, on revenue. If you dial that back to 4.5%, that would bring the par back down maybe to the 9% range. So here's a quick comparison. The Winnebago, Thor, and Camping World are both in this kind of recreational space. So if you think this industry interests you, I would take a look at Winnebago and Thor. And I always look at the price charts, because what they tell you is kind of how the whole world evaluates the company. I don't think you can predict the price tomorrow from a stock chart, but it does give you some indication. So what you can see here is, except for the big dip, the big COVID dip, this stock has continued to go up in value. If you look at it on a daily chart, a little more interesting, on the top there, the RSI, that's telling you a relative strength indicator that it's clearly not oversold at this point. And the bottom is something which just shows kind of which way the stock is trending. So you can see it's been in a kind of an up and down about the last 6 to 8 weeks. So summarize pros and cons. Why would you want to buy this stock? It's strong RV demand is going to continue into next year. It does have a diversified and synergistic business segments. The same technologies that go into parts of its business line seems to flow across several different segments. It's fairly valued right now, although it is a narrow moat stock. It's certainly not a wide moat stock. But it pays a good dividend, which protects it on the downside. The caution signs here, obviously inflation is an issue, qualified worker shortage. It's took on a lot of debt to buy that Furrion, and its cash flow has declined. So all of those things they're not reasons not to buy, but they're just things to be aware of. So in conclusion, I would say this is in the buy zone up to about $159. That's it. Back over to you, Cheryl.
Thank you, Ty. I will take back ownership here. All right. So we have put the LCII presentation in the handouts there. And so you are more than welcome to download that. And it has, as Ty pointed out, the SSG elements within that presentation. Since we could only do 5, we took out just the SSG where it's standalone. Anyway, presentation recap. We had Borg Warner, BWA, we had McDonald's, MCD, Medpace Holdings, MEDP, and LCI Industries. And I am going to open a little poll that we have here to let you vote on which one you would agree to do additional research on. And so I have opened the poll, and if you would go ahead and vote on your the one that you would definitely do more research on and more study. It's free to vote. Okay, we have 65%, 66. All right, we have 74%. I have a few more people voting. Get it up to 80. All right, gonna manage the poll. Whoops. Let me get back over here. Why did you go off? Hold on a second. Let me get back over here to the webinar here. And we're going to share.
We can see the results already.
Okay, very good. All right, so we've got, looks like Medpace is the clear winner here for 57% of the vote. And the second one is Borg Warner, followed by LCI Industry. And McDonald's has only 4%. So that is the poll here. And let me get back to. All right. And I'll hide the results here.
Hey,
So
Cheryl, excuse me.
sorry, go ahead.
Yeah, there was one question on here.
Sure.
If I could address that, and also to everyone else, if you have questions, you can put them in the panel on the side there. There's a area for questions. So this is from Denise Bao. I hope I pronounced that correctly. Her question is, are McDonald's sales decreasing because of competition? Is that a possibility? Yeah, I looked into that a little bit. Great question. And I should have addressed it in my presentation. As best as I can tell, McDonald's does an interesting thing. It actually during that time frame will close unprofitable stores. So the net result of that is that you're going to start seeing some decrease in revenues. However, the stores that remain behind end up being more profitable on average. So that's part of the reason why I noted on slide 54, revenues going down, but it was interesting to note, and maybe I didn't point this out, that earnings were going up. So the earnings going up is partly because of the remaining stores being more profitable. The other thing that kind of came up recently in a discussion, and thanks Jonathan Hun for the question or comment, I did confirm that in fact the other bit of, and some people call it financial engineering, and that was that they've been engaging in a pretty significant share buyback program. So from 2016 through 2019, the shares have dropped from 861 million down to 765. That will certainly make a dent in earnings. So thanks for the question. Hopefully I addressed it. Back to you, Cheryl.
Okay, thank you very much for explaining that and for bring that question to everyone's attention. I think that was a crucial point. What we try to do is we have this life cycle of a successful company. And as you can see, we got this picture from the SSG Digital Handbook to show where companies are on the growth chart, that you have start out as speculation, go into explosive growth, and then mature growth, and they either stabilize or they decline. If people would like
Are you
to,
showing that slide?
excuse me?
Cheryl, you're still showing the poll, not the slides.
I'm sorry, here, let me make sure. I did hide it, but let me make sure to, and we're gonna hide. How's that? Did it go back to the slides?
No.
All right. I don't know why I did that.
There you go.
All right, very good. Sorry about that. Anyway, if we could start out with Medpace and explaining why you think it belonged in the explosive growth area.
So it's a young company, as you know, it's only been on publicly traded for 5 years, and as more and more people see and companies see that it's doing a good job, it will continue growing at a fast rate. And so it has a ways to go before it has mature growth.
Okay. How about LCII? Ty, why would you put it there as the starting point of mature growth?
Well, I think it's in a it's way beyond the startup phase. It's not going to have explosive growth, but I think it's in a period now with the acquisition and the interest in RVs that it's kind of at the beginning of the mature phase is how I would rate it.
All right, very good. How about McDonald's?
So with 36,000 restaurants in 100 countries, I don't think we're going to see huge explosive growth beyond that. Pretty significant saturation. It's still a reasonable investment, but it's heading outside that green circle as far as being a strong investment opportunity.
Okay, and I think our viewers kind of agree with you since they've showed in the poll. How about Borg Warner? How about that one, Ken?
Borg Warner has been around since 1928. They have 96 locations in 24 countries, so they have a global presence, and they tend to grow by acquisition. So yeah, they're definitely mature.
All right, very good. Thank you for the explanations. All right. We ask you please to consider making a difference in someone's life. If you benefited from better investing, pick up some better investing materials and introduce others to this dynamic investment education opportunity. I know when I talk to people that I think better investing can do them some good, I will talk to them and start the conversation with it, and it's made a difference in some people. They've seemed very excited about it. And we've got a fun quiz going up here for McDonald's. You saw this on that screen where we had a bunch of the different products that McDonald's was selling in its restaurants. And what does anybody think are the main ingredients of this failed McDonald meal? And you can pick that up, run with that.
While folks are doing that, we have 2 questions that have been unanswered.
All righty.
This is for MedP. What was the reason for the large increase in sales, and why do analysts think that growth will continue? And this is from Al Waite.
Okay, the only thing I can say is that as the company builds a reputation for providing valuable services, it's going to grow. And as the biotech and pharmaceutical and those who make medical instruments need to find an outsourced company to do this kind of contract research, diagnostics, and get regulatory approval for their product, again, that industry is growing, and so Medpace seems to be able to get more and more work, and they have a big backlog as a result. And I'm not sure that analysts totally agree on this. It seems like they always underestimate it, and then earnings come out and they have to increase their estimates.
Yeah, I would have to agree with that, as well as maybe throw this in, that a lot of companies, because they're having to come out with products faster and to fill their pipelines faster, that they're going to, if they did before, cover this type of jobs within their own company, are looking to outsource that because it's not as profitable. The profitable part of the business is filling the pipeline and coming out with new products, biopharma or research. And I think a lot of these companies now are finding that that's one area that they do want to outsource with.
We have a second question, and that is for LCI. Regarding LCI, do they manufacture accessories for RVs, or do they acquire accessories for building complete units? And that's from Richard Yanku.
Yeah, but my understanding is a big part of it is they do that initial build out. They put specialized components in. I don't know if they make all of the components, you know, the stoves and the air conditioning units and that type of thing, but their expertise is fabricating all the accoutrements for these vehicles, and then they sell the not necessarily complete item to an OEM. So they're not the ones interfacing, as I understand it, with the ultimate customer. They're doing a lot of the buildup of the vehicles.
Okay, thank you. It looks like there's no more questions. I'm going to send out the answer to the quiz, and thanks for Aramita, Rudy, and Richard that correctly guessed that one of the ingredients is spam, and the second one is Oreo cookies. And if that doesn't give you some reservations regarding who came up with this idea, I don't know what will.
What's the white stuff?
I'm sorry?
What's the white stuff?
I don't know. They didn't include that in the description of it. God help if it's a mayo or something like that.
Special sauce. Top secret. All righty. I would like to use these last few minutes to say that both the Maryland and the DC regional chapters are run entirely by volunteers. And it's the volunteers that keep these chapters going and enable us to offer presentations like tonight's event. And so one way that you can get to also learn more about investing, because I know certainly joining the chapter increased my knowledge, is to volunteer with the chapter. You can learn new skills. You can learn from others and help educate others to this service. You can help to plan some of these events and classes, and the volunteers get to sit in for free. And you, again, as I said, improve your investment knowledge by attending BI national training programs and events at a discounted rate. You can receive complimentary subscriptions to the online data feed and the Mutual Education Fund Education Center on the Better Investing website. If you want to learn more about this and you would like to help, we want you. Come join the fun and help teach others. And you can again watch a replay on the YouTube page. There is that up here in the blue is the hyperlink that will get you to that YouTube page, or you can just go to YouTube and type in "digging into the BI" in the YouTube search window, and it will take you to, I think we have October through December right now, and then very shortly we will have January's as well. So please go and take a look. So, and investment education involves learn by doing. George Nicholson Jr., who was CFA, and Thomas E. O'Hara, they put together what is now Better Investing. And you can see the article in the Analyst Journal of May through June of 1968. These presentations were our judgments on the SSG, and we're doing this webinar as part of an investment education program for our fellow members in BI and their guests and people who just happen to find us and tune in. So if you like this content, consider joining us as a member of BI so you too can become a better investor. If you have any questions or comments, here are the top four are our presenters tonight, their emails, and then the people who are around and usually helping out. Kent DeJong is from the Maryland chapter. I am from the DC regional chapter. I happen to be the president. Marilee Hardesty is the president of MCMC, and Kevin Galogly, who is usually our announcer, here is his email as well. So please send us an email if you do have questions or comments about this. Now in February, we are going to have, again, go back to the first Monday. We did the second Monday this time because of the New Year's holiday weekend. So we're going to February 7th. It'll still be at this regular time of starting at 7 p.m. And the February featured stocks, the stock to study is Concentrix. And the undervalued stock is America's Car Mart, Universal Display Corporation, OLED, and Lithium Motors, LAD. So please tune in and sign up and register. We'll put out the registration links shortly, and you can register then for next month. And that is it. So I will leave up the emails here if someone didn't get a chance to write them down. And I thank you very much for tuning in. I thank our presenters tonight. You all did excellent jobs, and I really want to thank you for stepping up and doing your stop presentations. And thank you, the audience, for tuning in to us. And I wish you all a good evening for the rest of your evening.
Thanks, Cheryl. Thanks very much.
All righty. And I will talk to you tomorrow, Ty.
All right. See you tomorrow. Bye-bye.
Okay. Bye-bye.
Bye, everyone.
Yep.
Thank you.
Thank you.